everybody. Welcome. Thanks for dialing in. I'm really excited to have MGIC presenting this week. And Lisa Lanick with MGIC was friendly enough to get one of her team members to talk to us today about self-employed income and how to kind of look at that in a new way with all of these COVID changes going on. And so I'm really excited for this one, guys. We'll go ahead and get started. Lisa, I'll let you go ahead and introduce yourself and Jeff.
Thank you, David. Hey, everyone. I am excited for this actually, because I get this a lot from customers. I'm hearing that a lot of closings are delayed, a lot of just unaware of some of the new changes. I feel like this training can help just speed along and make your closings really smooth. Jeff Plattford is one of our awesome trainers. In fact, everybody loves him because he's just hilarious. And I think you'll enjoy this training. He'll make it as painless as possible for you. But I also want to thank you so much for all the business that you guys send to MGIC. I cannot wait to see everyone. I'm kind of sick of this quarantine that we're in. But Jeff, why don't you take it away? And thanks everyone. Let me know if you have any questions.
Awesome. Appreciate it, folks. Thank you very, very much. You folks are all located in a city that I absolutely love. I am in Columbus, Ohio, and we do come down to your city a couple times a year, one time a year, and spend way too much money on alcohol and music, but it's awesome. So I'm sure you folks living there, you're like, whatever, but from an outsider and a tourist, we just love it, love Nashville. So that doesn't really have anything to do with what we're going to talk about today, but we're going to talk about some of the changes that came into effect earlier this summer, real early summer, late spring. And Fannie and Freddie rolled out some guidance on, what the expectation should be when we're working with somebody that is a self-employed borrower. And obviously the reason for that is because of the pandemic and COVID-19. And so many businesses literally, unfortunately, had to literally turn their lights off. They were open one day and had to close the next. And it's just terrible scenario and situation. But then the question is, the more things that change, the more they're the same. I've been doing this in this business for, fortunately or unfortunately, a long time. And, when I was in underwriting 20 some years ago, excuse me, we got profit and loss statements for every self-employed borrower, and we get the profit and loss statement. That's not new. That hasn't changed. We get the profit and loss statement. It was really to do a quick double check to make sure that year to date, this business is on track and in line with the prior year or the prior 2 years. So that part hasn't changed, with the exception that we went probably 10 or 15 years, the last 10 or 15 years, where profit and loss statements really weren't required. So we didn't get them. And, when we talk about stability and likeliness to continue for income and employment, we've always dug deeper. We've always done a more due diligence when we work with somebody that's self-employed. So the piece of self-employment where we look at one or 2 years worth of tax returns has not changed at all. The piece that has changed is we now are being required to get profit and loss statements year to date. And the big concern is we want to make sure that this business has indeed reopened. And if it's reopened, we really have to assess the impact of, is this business stable again? Is it back on track? And really, that's the big kicker here. I'm in Columbus, Ohio. You folks are down in Tennessee. Every governor has had different standards on when things closed, when businesses closed, when businesses opened, how they've reopened, if there's limitations, those types of things. All of that has to come into play when we talk about providing a mortgage and doing lending for somebody who is self-employed. And it's tough. It's just really a tough predicament. So with that, we've always, as I mentioned, excuse me, you folks all have a worksheet that you utilize when you're calculating self-employment income. And I mentioned that that piece has not changed at all. We're still looking at those Schedule K-1s, and if they own 25% or more of the business, we're getting the business tax returns. That piece, as I mentioned, again, has not changed. But what we did at MGIC is we thought, you know what, maybe we could provide to you, our customer, a calculator, a tool to try to help you get your arms around a better understanding of that profit and loss statement. So I'm going to share that with you here in a second. But before we do that, we're going to get these profit and loss statements in the door year to date. You might see them come in the door as an income statement. That's fine. It's the same as a profit and loss statement. And that income statement is going to talk to me the same way that your tax returns are set up. If you folks envision a Schedule C, the first page on that sole proprietorship is all the income that came in the door, all of the expenses and the bills were paid. I've got my bottom line, profit or loss, positive or negative. Your income statement, your profit and loss statement is going to be formatted and set up the same way. So at least that's good because you can tie them together. And I'll show you an example here in a second. And on the right-hand side of this screen, I do mention a balance sheet, which talks to me more about the financials of the business. And balance sheets are not a requirement for Fannie and Freddie. The profit and loss statement is. However, you might have your own internal overlay twist, or you might work with an investor that you sell loans to. They might have a twist, and they could say, you know what, we are going to ask for a balance sheet. We're going to get a little more than what's maybe needed or required. So I'm going to give you an example of both of them. Before I show you the profit and loss statement, the profit and loss statement is going to come into you folks one of two ways. It's either going to be unaudited or audited. And I would have to believe you won't see audited statements very often. My experience with audited statements is that it will cost your borrower or their business literally thousands of dollars to get audited statements. Very, very pricey, very costly. If you get an audited statement, that's all you need. We're going to run with that and make a decision. But if you get an unaudited statement, which I think you're going to the majority of the time because it can be self-prepared or provided by the CPA, if it's unaudited, that's completely acceptable to the agencies, but you also then have to get bank statements, and that's an extra kicker. So, we want to get at least a minimum of 2 months of bank statements. Although I know there are some lenders out there, some investors out there that are saying they want 4 to 6 months bank statements. So it's going to depend on maybe who you're selling your loans to, or maybe if you have an internal overlay. But a couple of things to think about with regards to the bank statements. First off, when we're working with some business owners, specifically Schedule C sole proprietors, many times those folks don't have business accounts. They just, they have their checkbook and they pay their electric bill at home and they pay their electric bill at their business. And it all comes out of one account. When you run into that scenario and they say, I don't have a business account, I just use my personal account, that is completely acceptable. We will take that. What we're going to do with that bank statement or an actual business bank statement is, and this is the part I feel is the most gray of the gray area, there's not a lot of black and white here, is to the best of our ability, we're going to look at those deposits, look at those balances, look at those expenses, and try to tie that to what the borrowers are saying they are actually making as a profit compared to the profit and loss statement. An extra kicker here is that if there are any of the PPP loans, which are the loans that were created in one of the stimulus packages earlier this year, I don't remember when it was, maybe April or May or something, those were payroll related loans for businesses, and a lot of businesses got those PPP loans. And I think from my experience at this point, a lot of those PPP loans are gone. They've been exhausted. Those funds are gone. And so, however, if you're working with somebody and the bank statements include those PPP loans as a part of the balance of the bank statements, we want to make sure those get deducted out and we get a more true picture without the PPP funds. I think this was more of an issue maybe in July when the PPP funds were still on the books and being used for payroll. But from what I've seen, and I've got a couple friends and a brother-in-law that all own businesses, that, you know, it seems like those PPP loans, the funds have been exhausted by now since we're already in the middle of October. So something, again, to keep in mind there. So as I mentioned, you know, regardless if I'm looking at a Schedule C or a partnership or an S Corp, how these documents are formatted are going to flow together. And we're looking for comparisons on that profit and loss statement for sales and cost of goods sold and profits versus my expenses. And we want to take a look at that and compare it to last year. Because again, the whole point of us asking for all of this new information and year-to-date information is the word I constantly use is this business stable? Has this business stabilized? Is the stability there? However we want to spend the word stable, that's really what we're looking for. Are they back on track? Excuse me. If you were to get a balance sheet, we're going to do the same thing with a balance sheet, but to compare that balance sheet and those assets, I'd recommend that you go inside of the business return and go to Schedule L. And a lot of you folks on this phone call might think, well, heck, where's Schedule L at? Well, Schedule L is where you're probably already used to going to. If you've ever done mortgages or notes payable in less than a year, those words make a lot of folks cringe. You know, it's on every worksheet out there. We've got to subtract that out. So that's in Schedule L. So you're probably already accustomed to going there. We're just now going to twist it a little bit. Schedule L is a balance sheet. And again, we're going to look at comparisons if you have this balance sheet to last year's Schedule L and the balance sheet inside the business return. Again, just a reminder, balance sheets are not required by the agencies. But again, that's not to say you have an investor or somebody that does require them. All right. So I mentioned to you that we created at MGIC a new tool, a new worksheet, and I'm going to go and pull that up for you here. And it looks like this. And some of you may use our MGIC self-employed worksheet. It's completely interactive. If you do use this, you just click on the radio buttons and you can plug and play basically. But down here at the bottom, we added the P&L statement here. And if you click on that, it will take you to the profit and loss tool that we just created and rolled out. And it's pretty slick because I think it's helpful just to keep you focused if you don't have a great comfort level yet, or maybe if you do and you're just exhausted because we've all been so busy with volume. You don't have to use our self-employed worksheet to be able to use the P&L. They are not exclusive to each other. You can use one or the other or not use any of them. It's just something we've created. So regardless if you use this or not, I just want to give you a couple of examples of what you're going to see if you're starting to gather this documentation. And I just happened to go under a Schedule C. I typed in ABC Company and I did 2020, and you can plug this in however you want. And I did January through August. I probably need to change that to like October. And then 2019, I did all of last year. And we tried to use the same language that you're already used to seeing on your worksheets. Hey, go grab the profit or loss, deduct out any non-recurring income, add back depletion, depreciation. This is all language that we're already used to seeing if we're using our worksheet to calculate self-employed. If you're using Fannie's or Freddie's or ours, they all have a same similar feel and flow to that language. So we kept that part the same. But I'm giving you this example for a couple reasons. So it seems like there are more extensions on tax returns this year than in the past. And I don't know why that is, but my guess is that we all know, I live in Ohio, you're in Tennessee, tax day every year is April 15th. You got to have them filed, you got to have them done. Well, this year, because of COVID, the government pushed that back to July 15th. And again, I don't know if that's the reason, but I'm guessing it might have something to do with it. But we're seeing more and more extensions. So once you have that extension in your hand, you're not going to have 2019's tax returns. They are not completed yet. But in that scenario, I would recommend that you get a profit and loss statement for all of last year, and then also a separate profit and loss statement for this year, year to date. And once you get that information, that's what I've plugged in here just as an example to show you that you can use this worksheet that way if you choose to. And then we give you the total broken down by January through August 10th, so whatever that is, I don't know, 7.25 months. And we give you the monthly right here, 72.40 and 64.16. The other way that you might work up a profit and loss statement, and that the agencies say is completely acceptable, and what I might recommend is, if you can, when you get your profit and loss statement, or I should say when you request it, when you request that, see if you can get them to break out that year to date, month by month. Because I think that's going to help underwriting get a cleaner, clearer picture, be able to make a more accurate decision for that stability piece that I keep referencing. So in this example, you can also use our worksheet, this tool, and just make it monthly. And you can create it however you want, but in this scenario, I put 2020 across the board. I did March, April, May, June. And let's just say, I don't know, let's say 2019's returns were done for this business, XYZ company. And I see that they made about $5,000 a month. In January, February, March of this year, they made $5,200 a month. You'll see here on my little worksheet. But then they had to go dark and they had to turn the lights out because of COVID. And you'll see in April, the numbers just plummeted dramatically. And we know that. We understand that. We know we're going to see this. And then let's say maybe sometime in May, they were allowed to reopen. And then you'll see June, July, August, you'll see these numbers growing again. And they're going back in the correct direction. They're not at $5,200, but we can sure see through the summer months, now into the fall, we're sure trending to the correct direction, which is awesome. So that leads me back to, and I'm going to flip back to my PowerPoint here so we can start to wrap up. But because I know you folks are busy and we set aside 30 minutes, so I don't want you to think I'm in a rush. So if we have questions, that type of thing. So I've got a couple just quick scenarios that I want to tie all of this together. So the first scenario is, you'll see here on the left-hand side, it says year to date, $31.67 a month. And on the right-hand side, it says $28.79, and that's for last year, just 1 year divided by 12. And I'm trying to get a little pointer here, maybe. I apologize. And you'll see we have income that's stable and income that's increasing. So our year to date in this scenario is awesome. Again, I don't know how often we're going to see this, hopefully often, but it's awesome. My year to date is stable and increasing compared to last year. But keep in mind, just like we did 20 years ago, when that's the scenario, we don't use year to date wages in our calculations. We just use our tax return wages. So we would use $28.79 in this scenario. We would not include the year-to-date profit and loss statement. Now, with that said, if I change my scenario and I've got $2,100 year-to-date monthly, and over on the right-hand side, I've got $28.79, you can see that it's declining. So my income's declined. So now the question is, you got one or two options here. Is this stabilized and I'm going to use this wage, or has it not stabilized? I know it's declining, but can I use this? So if you decide that I'm going to use this income because it has stabilized, we are going in the right direction. If you think about my example I just showed you on my worksheet, I was making $5,200 a month, and then the bottom dropped out, but now I'm up to almost $4,000 a month. I know I'm trending in the right direction. I can see that via the numbers. If that's the case, we're then only going to use the year-to-date lesser amount. So we're flipping it here. My first scenario was increasing, use the tax return. Don't use the year-to-date. In this scenario, it's stabilized. Don't use the tax return because it's higher. We're going to use the lower amount on the profit and loss statement. My last example is the same numbers are sitting here, $2,100 monthly year-to-date versus $2,879 last year. And I know my income's declining, but it has not stabilized. And if you deem that it has not stabilized, then at that point, we're not going to be able to use any of this, unfortunately, to help qualify our borrower. There's one last piece I want to close with, is that when we use the scenario, I have declining income, and this declining income, it does appear that it's stabilized. We are going to use this lesser amount. Please make sure you also get an additional letter from your borrower or your CPA. And Fannie and Freddie would like to see that letter in the file to help to understand the thinking of why we're using the declining income and the reasoning behind it being stabilized. So examples of that is a letter stating why the business and the income dropped off substantially, and that was due to COVID, that this business has fully reopened, that this business is fully operational, and that it is on track. It has stabilized. The numbers are growing month to month. So we want to make sure that's included in the file also. When you have that scenario of declining income but stable. So we are already at the end of our time. And I think, and I apologize, I think this was set up, David and Simon and Caitlin, that we're not able to open this up to questions. So I've covered what I've wanted to cover. What I'd like to do is change or turn this back over to Lisa.
Hey,
Lisa,
Jeff,
you
it's
and
Lisa.
David.
Can you hear
I'm
me?
sorry.
I think the participants can leave questions in the chat if they need to. So you just want to give them a few seconds.
Oh, there it is. So folks, I've just popped that chat box up. So any question that you have, please, please, please type them in there. We'll get them addressed for you. Hopefully you also got a chance to print off these materials. They should have been included as, we put them in as attachments that you could print those off and use them as reference in the future also.
And then also they can email me if they have any questions I can forward to you.
Yes.
To get those questions answered.
Perfect. And
my email is Lisa
_
Lanik. Yeah, it's Lisa _ Lanik, LANIK at MGIC.com. And I'll get that question to you if we need to.
I would love that. Well, folks, I'm going to say thank you very much for your time. Thank you for having me. And Lisa, I'll let you close it up.
Thank you, Jeff. I appreciate it. And I hope everyone stays safe and surviving this refi boom that we're in, that, you know, we have to be thankful in times like this, even though it is a little stressful sometimes. But just remember to use MGIC when possible and try to just test our pricing out as much as you can. I appreciate you all and have a wonderful Thursday.
Thank you, folks.